Well, the global economy is feeling the strain of years of subpar growth. The United States is still forecast to grow at 2% this year, while the Chinese economy will increase by 7.8%. Earlier, I asked Goolam Ballim, chief economist at Standard Bank, whether African economies should focus more on China growth rather than the United States.
So even though China is roughly half the size of America's economy, China still is the world's marginal price setter and consumer of resources. And resources, of course, dominate South Africa's export basket. So one can argue that, at least at a surface level, China matters more than the United States. However, we must not make the mistake that economists, analysts did make during the 2009 downturn, and that is failure to recognize what we call network externalities or globalization. In other words, the world is connected. So if the US economy subsides, China will be affected. China's own industrial health is a function of individuals going to Walmart and buying trinkets and toys in the United States. So it's an integrated planet, and that bears consideration as well.
South Africa, of course, we've seen pedestrian growth relative to other emerging markets. Your forecast for this year is sitting at 2.3%. And of course, we've seen subpar 3% growth for some time now. Why is South Africa's growth so pedestrian?
It's reasonable to blame some of our current trajectory on the international environment. South Africa is a very open economy, and 2009 was an absolute smash. In fact, in 2009, the South African economy lost momentum that was twice that typically experienced in past recessions. So we have been struggling to recover from a very low point. Notably though, despite the exogenous shock internally, South Africa's growth dynamics, be it either the political setting or just simply the level of infrastructure in proportion to GDP and incremental contributions to our stock of infrastructure, has not been entirely suitable to generate a higher level of economic performance. I think we have to recognize in the end, it is the quality of human and physical capital, the environment that encourages enterprise and entrepreneurship, that encourages growth. And there have been several internal factors that have probably gnawed at South Africa's potential in that respect.
Let's talk about the government and fiscal space right now, because of course we went into the recession with a surplus, which was great from being able to have that fiscal space to support the economy. But is the government's ability to do that waning?
Governments have a very potent stabilizing influence in an economy. One can argue almost uniquely so, but then sometimes we see central banks also play a very potent role. The government's budget balance is menacing, and its debt stock as a proportion of GDP is twice that prevailed before 2009. So quite clearly, government's role can only be temporary, and the government is probably at the tail end of its capacity to be providing a stabilizing force or even injecting a smoother growth profile to South Africa's economy. Increasingly, it is going to have to rely in the near to medium term on the private sector for recovery, both households and fixed investment.
Let's talk about households, because 4.8% growth in consumption expenditure in 2011, and that's almost halving to 2.6%, which is the forecast for 2013. So what's your prognosis when it comes to credit-fueled household spending and overall that relative to real incomes?
In 2013, especially the first half of this year, South Africans' incomes after inflation is going to grow slower than last year. Added to that, their access to credit or their capacity to take on more credit is not going to be as healthy as last year. So as a function of that, you're going to see that consumer spending is likely to be slower this year from last year. And given the weight of household spending in the economy, that suggests that a significant cylinder is going to be underperforming, shaping the overall growth outlook. So yes, from 2.3% last year, we think that growth will be about 2.5% this year. So very similar real feel.
So if the government is losing fiscal space, consumer spending and consumers' ability to help fuel the recovery is diminishing. What about the private sector? I mean, is the private sector able to step in? Do you think that they will step in?
So first, what we do need as a stimulant for growth is an improving global climate, and at the margins, conditions there do seem to be improving. And secondly, you need a climate where risk-taking is encouraged. So the private sector, especially the captains of industry, to the extent that the political system encourages risk-taking in 2013 relative to last year, that can provide some level of impetus. While there will be a lower level of exuberance on the part of households this year compared to last year, I still think they will participate with some level of impetus to the economy, but not as meaningfully.